This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Justin Harima, I'm from Grand Rapids, Michigan, and I'm at Meet the Masters, and it is going awesome. I've actually been learning a lot about trusts and tax benefits to real estate and how to invest with IRAs and those sorts of things. I've been investing actually well over 10 years now, and I learned a lot of new things today. So I was pretty surprised that there's some techniques out there that I'd never heard of with how long I've been doing real estate. So it's really great.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome, empowered investors. This is episode number 2283, and I'm coming to you again from Medellin, Colombia. I'll be here for a couple of weeks, and then I will be headed to California for Empowered Investor Live. I hope to see you there. Today, we have a couple of things to go over, and not the least of which is a follow-up on what I mentioned on the last episode, and that is about the crazy theory that actually, since I mentioned that on Monday's episode, seems to be gaining steam, because now I've seen several other articles about this theory. And what is that theory? Is it a conspiracy theory, or is it just a theory? I don't know. What defines conspiracy theory versus just a theory? That's a good question. Well, this one is about, is the Trump administration trying to crash the economy? And you know what? It doesn't need to sound that dramatic, right? It's not really that dramatic. Trump possibly, and now I begin to agree that this is likely, that Trump is trying to slow the economy in order to set up the case for lower interest rates. And there does seem to be some real logic for this. But look, let's listen to someone else. Let's get another opinion on this. And that comes from where I read this first, although I don't know that he was the first to say it or think it. And it comes from Anthony Pampliano's newsletter. I have not had him as a guest on the show. We've got to get him on. He's an interesting guy. And I have met him in person. I shared the stage with him at a speaking event in, where was that? I think that was in Miami, I believe, a couple of years ago. Anyway, let's listen to what he says about it, because I think he makes a pretty interesting case. So here we go. We will just listen on my cell phone. So pardon the sound quality. It's only for a couple of minutes.
The big question in financial markets over the last 2 weeks has been, is Donald Trump intentionally trying to tank the U.S. stock market? This would have been an absurd question before the inauguration. The general thought process was President Trump is a businessman and an investor. He measures the health of the U.S. economy through the stock market performance, so you can expect the stock market to go up if Trump becomes president. Now, I know this was the consensus because I believed it too. There was no obvious reason why Trump would allow the U.S. stock market to drop, let alone take actions to crash the market himself. But that's exactly what's happening right now. Here, I've included a video of President Trump talking over the weekend about his plan to get interest rates and energy down. Now, once you watch that video, you got to understand how this works. Chris Patel and Amit is Investing highlight how the plan works. They say that we have $7 trillion of debt that we need to pay back in the next 6 months. If we don't pay it, we'll have to refinance. The Trump administration does not want to refinance at a 4% or more rate. And so the 10-year at one point this year was 4.8%. So they got to get that thing down.
Now, remember what I told you about this. Of course, the big debate and the problem the government has and the problem the Federal Reserve has, you all know it. You know what I'm going to say, right? This is elementary school stuff. But the problem is, you lower interest rates, the economy gets too hot, it heats up too much, and then you have an inflation problem. So you raise rates to solve the inflation problem, then the economy becomes stagnant. And nobody is happy ever with either thing. There's always people on both sides. During the low interest rate era that we had, and still historically rates really aren't that high, but I know we look at our recent memory and we think rates are enormously high right now, but they're not. Anyway, people always talked about this new phrase that we heard, financial repression. What is financial repression? Well, different people have different definitions for it, but I had Dan Ammerman on the show many times. He talked about it a couple of times when he was a guest. By the way, we've got to get him back on. It's been a while since Dan's been on, and I know a lot of you like his work. I do too, but he talked about financial repression, and one form of financial repression is to have very low rates. So especially seniors and very conservative people can't get a decent yield on their money in a safe investment. So they have to go farther down the risk curve and take big risk to get any kind of yield on their savings that they worked their whole life to have that investment nest egg. So it is interesting. And of course, this is a problem. Now, Trump is going to lower energy prices for sure, because his motto is drill, baby, drill. The first day Biden was in office, he canceled the Keystone Pipeline, put a bunch of people out of work. And, his administration said, who cares? Go get another job, right? But, asking federal employees, what did they do last week? Oh, that's just offensive. You can't do that. It's the level of ridiculousness in today's world is beyond the pale. My point was that the government wants low rates because, of course, the government is the world's biggest debtor, right? We are the world's biggest debtor nation. But, when you hear that, don't freak out about it, because the question is, compared to what? We're also the world's biggest economy. So it's all relative. In fact, relatively speaking, if you look at, the third largest economy, Japan, they have a much higher debt to GDP ratio than we do, dramatically higher. I think like 260%, more than double what ours is. So we're not that bad. We can afford to have a little more debt, but we do want that debt at the lowest possible rates, just like we do as real estate investors. That's the same way we want it as a country, as a nation.
DOGE has to be perceived as actually working, and then interest rates need to come down as well.
And DOGE itself, the Department of Government Efficiency, Elon's group, that alone may push us into a little bit of a recession, because think of all the money that is being cut off to all of these undeserving people and all of these people who were they've just been leeching off the system for decades, leeching off the American taxpayer, and it's awful. But of course, that does create an adjustment. A lot of those DOGE recipients, well, they're somebody's tenant, right? So if they got laid off from their job, or the gravy train stopped for their fraudulent charity or foundation that they had, or whatever it was, that does have a ripple effect into the economy, of course.
The way to do that is to create massive uncertainties, aka tariffs, which can slow down growth in the short term, get the bond market to start buying bonds as soon as possible because of how scared they are, and they will not touch stocks, which cause yields to fall, which is what they need to refinance the debt. And then that gives the Fed the authority to lower rates, which continues to bring yields down. So although conventional wisdom says tariffs are inflationary and the 10-year should be spiking on more tariffs, is actually going down because it's bringing so much uncertainty to equity markets that people are selling stocks and buying bonds. That's exactly what the Trump administration wants to happen in the short term in order to bring refinancing costs down. So this is not obviously the easy way to get interest rates down. The easy way was to have the Federal Reserve cut interest rates at the start of the year, but that did not happen. In fact, many of you may remember that Trump kept telling Jerome Powell to cut interest rates last year. Powell was public in his defiance of Trump's request. So now Trump and Scott Bessent are taking matters into their own hands. They're crashing asset prices in an attempt to force Jerome Powell to cut interest rates.
And remember, Scott Bessent is the one who said the economy is going to need to detox. And that's an exactly right concept. It's exactly what needs to happen. And it's just the right way to say it, because there's a lot of detoxing. We have had toxins in our system for so long, with so many leeches, so many people leeching off the system. And I'm not talking about the welfare recipients, right? That's nothing compared to the kind of just corruption that we have had for so long. And look, I don't need to tell you the DOGE reports. You can read them yourself. Just look up all of the examples of just utter disgusting corruption that has already been uncovered, and a lot more will be uncovered.
We will see who blinks first. But don't believe me. Here is Trump explicitly saying that you can't watch the stock market right now. And watch the video and email. So the entire administration has their eyes on the 10-year Treasury yield. But even without Powell stepping up to the plate and slashing interest rates, we've already seen the 10-year drop from 4.8% in January to 4.25% this weekend. That's a good start. We are going to need much more movement on interest rates, though, if we want to have a profound impact on our refinancing costs. Lower interest rates don't merely affect the U.S. government, though. The drop in interest rates since the start of the year have helped drop mortgage rates as well. Chris Patel points out that as interest rates decline, more buyers will emerge, so will many sellers. We need the housing market to thaw. Now, housing is not the only game in town that benefits from lower interest rates. Perplexity, my favorite AI search engine, explains that lower interest rates generally benefit American consumers by reducing borrowing costs, making it cheaper to finance large purchases such as homes, cars, or education through loans or mortgages. This can also increase disposable income, encouraging spending on big-ticket items and boosting economic activity. So how many interest rate cuts can we expect in 2025? Well, prediction market Kalshi says the market has increased its expected number of rate cuts. It now gives greater than 75% odds of 2 or more cuts this year.
Wow.
And Kalshi is also showing a 38% chance of a recession this year, which obviously plays into whether we'll get more interest rate cuts or not.
And remember, folks, a recession does not necessarily mean a real estate recession. But hey, I'll be the first to tell you, as I have many times over, the real estate market has been boring. It's been anemic. Some markets have suffered, like Austin, Texas, a couple of markets in Florida as well. But overall, the big macro trend is very, very favorable. But they've got to get that to cool in order to lower interest rates. And as soon as those rate cuts really hit the mortgage market, it's like, boom, I have seen it. Boom, boom. So many times over the years. I've been doing this for decades. I've seen so many cycles. I know exactly how it happens, where people just rush into the market. And then suddenly you thought there was a decent selection of houses for sale, like there is now, but all of a sudden there's just not. We only have about 650,000 homes for sale, about 0.5% of the total inventory, the total housing stock, which is about half of normal. So suddenly, when houses get a lot more affordable, as those mortgage rates come down, and that's where they're going, we all know that, right? Exactly when, none of us know, not even Jerome Powell. But we know that's the direction they're going.
Is Donald Trump, Scott Bessent, Howard Lutnick, and the current administration trying to pull down asset prices? Absolutely. They're literally telling you on every public interview they do what they're trying to accomplish. And they claim to be focused on Main Street over Wall Street. The big goal is to get interest rates down, which will lead to more economic activity thanks to access to cheap capital. This is not your grandfather's economy, and this is not your grandfather's economic policy. No wonder there is so much controversy over the strategy. People hate new things, especially when they are bold bets coming from one side of the political aisle. But if we end up with lower interest rates and can somehow avoid a recession, we all will have to tip our cap to the current leadership team. I don't envy their position. Something new has to be done since we can't continue on the path we're on. Let's all hope this plan works. Millions of Americans are depending on it. Have a great start to your week.
All right, so that's it. So here I'm going to play that video he mentioned, and we will go ahead and get to our segment today, which is Ric Edelman talking about the idea that I've talked about many times of the 10 great reasons to carry a big, long mortgage and never pay it off. It's coming up right after the Trump video, and we are looking forward to seeing you in just a couple of weeks at Empowered Investor Live. Go to empoweredinvestorlive.com to get your tickets for that event. It's going to be a great time. We look forward to seeing you there. And before we go, let's hear an interesting clip of the day.
But you may get it again with these tariffs, right? I mean, one CEO said to me, my input costs have already started to go up. Well, I'm going to have to raise prices.
In the meantime, guess what? Interest rates are down for the last 3-4 days at good levels. I mean, you know, when you add interest rates, you're talking about it's gone down. I've been saying, let's get interest rates down. You know, nobody ever gets rich when the interest rates are high because people can't borrow money. Interest rates are going down. You know what else is going down? What have I been trying to get down? Oil. Energy. Energy's going down. I'd love to see energy go down. You know, energy is really what caused it. They screwed up my energy. I had the most energy and they screwed it up. Then they went back to it. It was going through the roof. They went back to some drilling, but it was gone. It was hopeless. It was lost. But energy's gone down and interest rates have gone up over the last week. That's a big thing. I love that.
What sums up sort of the Ric Edelman philosophy, if you will, toward investing?
3 simple strategies. First is diversification, as we've mentioned. Second is to maintain a long-term focus, which we've also mentioned. And third is to rebalance that portfolio in order to make sure that you maintain the diversification that you're desiring to develop. So that's really it. Diversify long-term and rebalance the portfolio. And if you accomplish that, you'd be amazed how easy it is to generate above-average returns with below-average risk and below-average cost.
Good point. Would you consider yourself a contrarian?
To a degree, I think you can argue that. We definitely do believe that most consumers make the wrong investment decisions at the wrong time, and we stand apart from that. So I do believe that to a degree what we're doing has a little bit of a contrarian element. We are not pure contrarian. I mean, there are some folks who deliberately and specifically make investment decisions that are the opposite of what the masses are doing. We don't do that, but we do look with disdain at the general school of thought that most people emulate at a given moment.
One of the things I really love about your work, Ric, by the way, is that you really put it into very plain, simple language that everybody can understand. And that really is, it takes a lot of wisdom to do that. And my original discovery of you was the 10 great reasons to carry a big, long mortgage and never pay it off. And I think you just start out with reason number 1, and maybe we'll go through a couple of them. You can take your pick, but your mortgage doesn't affect your home's value. And that's so interesting because the market will do what it's going to do. It'll go up, it'll go down, but it's not related to the amount of the mortgage, which it's just so funny that people don't see that sometimes.
You're absolutely right. And in this past economic crisis, when millions of people have lost their homes due to foreclosure, a lot of people are blaming the mortgage for all of this. And that's not true at all. Nobody in the last several years has lost their home because of their mortgage. The reason they lost their home is because they've simply bought a house that was too expensive.
Yeah.
They couldn't afford it. The mortgage had nothing to do with it. And we need to recognize that point because, as you've noted, your house is going to go up in value or not, whether there's a mortgage on it or not. The mortgage is not relevant to it. So people who fear mortgages fear them unnecessarily and incorrectly. And that is why you've got the first step is to get comfortable with the fact that your mortgage is unrelated to the value of your home.
And you know what's interesting about what you just said is that no one really lost their home because of their mortgage. And I agree with you, Ric. And they lost it because they were living in a home that they could never afford in the first place many times, or their circumstances changed and made it so they couldn't afford, job loss, etc., right? But what's interesting is the way the politicians, you saw it with both McCain and Obama, the way they made this mantra of let's keep everybody in their home, never mind the fact that someone who's a school teacher and has a lower income is living in a house way beyond their means. Now, if they paid cash for that house, if they had the cash, or if they put a lot down on the house, they still wouldn't have been able to afford that, but they would have taken the hit to their savings, their equity in the house themselves, whereas the lender many times took the hit through a short sale or a foreclosure. And it's really odd how this becomes a political football when these people got the benefit of the bargain, I think. In almost every case.
It's a very complicated situation, obviously, as to what the causes of the credit crisis. There are lots of guilty players involved. The politicians are guilty. So is the mortgage industry. So is the real estate industry, the appraisal industry. So are the consumers themselves, who insisted on buying homes that they couldn't afford and creating the demand to which the industries and the government responded. So everybody's guilty in this situation, and I think we're all simply hoping that we've all learned our lessons about this and that we don't repeat it. We hope that the lending rules get tighter to prevent people from obtaining loans that they really, frankly, can't afford. We hope the regulations are designed to prevent abuses in the industry, and we hope that consumers start to act a little more maturely and not demanding something that, quite frankly, is beyond their financial reach. So hopefully there are lots of lessons learned in this economic crisis, because if we don't learn the lessons, then we are simply doomed to repeat them.
Santiana, said, those who don't learn from history are doomed to repeat it. But you are very right, Rick, that there were a lot of co-conspirators, including the secondary market, the derivatives pools, all of that good stuff in this whole thing. Tell us about, though, some of the other 10 reasons.
Well, another one that I really like is the fact that a mortgage will not stop you from building equity in your house. It's really interesting that people fear that if they have a mortgage, it means they're always going to owe a huge amount of money on their house. They're never going to get rid of it. And that's simply not true, because although housing prices have fallen over the past few years, that's only because they had risen so dramatically in the several years prior to that. Over long periods of time, 10, 20, 30 years, housing prices have always risen. And therefore, because your house is going to grow in value at 3% a year, the house is going to double in value in about 23 years. So at that pace, even if you never make a repayment on your loan, your house will be worth twice as much as it is today. So clearly, the mortgage is not going to stop you from building equity in your house.
Very good point. No, it has nothing to do with it.
And another element that I like, Jason, is that right now mortgage rates are at historical lows. They're around 4%, 4.25% on a 30-year fixed-rate loan. You will never see this again. We haven't seen these kinds of rates ever. And as a result, you have to ask yourself a question. Can you invest money for a 30-year period of time and earn more than 4.5% per year? The stock market's averaged 10% a year since 1926. The bond market has averaged about 8% a year since 1926. The real estate market has averaged about 9.5% a year since 1926. So clearly, the opportunity to earn substantially more over very long periods exists. That doesn't mean you're guaranteed to do so. It just simply means that historically the potential has been achieved. So on that basis, the fact that mortgages are so incredibly cheap creates a wonderful opportunity to help you build wealth. And of course, mortgages are tax deductible under current law, which makes that 4.5% rate even cheaper. I mean, to be able to borrow on a 3% net of taxes rate is absolutely fabulous, and people should really maximize their opportunity to take advantage of it.
One of the financial advisors that we work with here, he always says most people think of it as the house is the asset and the mortgage is the liability, when in some ways that's reversed, because the mortgage, if it's a 30-year fixed-rate mortgage at a low rate, that is really a huge asset. And I would much rather see people lock up those long-term fixed-rate mortgages on multiple properties and then use that money in other ways rather than putting it into the property itself, and use the borrowed money in the property as long as it's long-term fixed rate, low rate debt.
It's interesting you say that you refer to it as an asset, and you're absolutely right, Jason. I don't like debt. I'm no self-respecting financial planner would ever encourage people to go into debt. I don't like debt. Debt is dangerous. It's very bad, and we've seen the big problems people have with payday loans and auto titling loans and credit card loans and things like that. But a mortgage is not a debt. A mortgage is a financial planning tool that can help you actually achieve wealth. Because if you have a mortgage, it means you didn't give money to the bank when you bought the house. It means you were able to retain that money, which you, if you managed it prudently and properly, could have invested, enabling you to create wealth that you otherwise would have been denied. So a mortgage is not the same as other debts. It is, in fact, an asset-building tool.
I think that's a great point, Rick. No question about it. The mortgage is a huge asset. And one of the other ways I like to say it is that a mortgage is self-sustaining, or better yet, a mortgage is self-liquidating debt. So when it's not against your home, when it's against an investment property, that property should be self-sustainable, and the property itself, the tenant, pays the mortgage for you. You're outsourcing your debt the same way large companies are outsourcing their call centers to India.
I just want to make sure that when you're dealing with investment real estate, that you have ample cash reserves.
Right.
In case you do have a problem with that tenant, because eviction is very, very difficult. You, in the meantime, still have expenses associated with maintaining the property. So we just want to make sure that if people are going to acquire investment real estate, which is perfectly fine for a diversified portfolio, that you have sufficient cash reserves to be able to manage the property effectively.
Good point, no question about it. Rick, what are some of the other hot tips on these 10 reasons? And by the way, everybody, the website is ricedelman.com, where you can find the 10 reasons, and that's RIC Edelman.com. And these are just great, but pick a few more for us, Rick.
Sure. It's the easiest way to spell it is ricedelman.com. Just call me Rice. Easiest way to spell the website. Another reason that mortgages are favorable is because the payments get easier over time. If you get a 30-year fixed-rate loan, you're going to have a monthly payment, and that monthly payment will never go up. Your P&I, your principal and interest payment, will be locked in for 30 years. But over that 30-year period of time, your salary will grow, if only because of inflationary increases. So because your income is going to grow and the payment does not, the payment effectively gets easier and easier to make as you get older. People tend to struggle hard with their first few months of payments because they've applied all their available cash to the down payment and they're not making a whole lot of money and they're struggling. But 5, 10, 20 years out, that payment becomes very, very easy to make. So mortgages, which seem daunting in the beginning, become a no-brainer as you get older.
It's interesting how that perspective changes. I remember when my mother, Rick, bought her first house in 1976, the payment, which I do remember as a child, her stressing about the payment of a whopping $416 per month for a house in a decent area in West Los Angeles. And over the years, she still owns that property, lived in it, rented it out later, and that payment seemed like nothing by the time you hit the mid-80s, the 90s. It turns into nothing through inflation, so that's a very good perspective. One other tip on the mortgage thing, and then we'll maybe wrap up here.
Another one is that by having a mortgage, as we've briefly covered, it enables you to invest money more quickly than you otherwise would. And by investing more quickly, you're able to create more wealth.
Excellent. Good stuff. Well, Ric Edelman, thank you so much for joining us today. Anything else you want to say in closing to people just to kind of wrap this up?
Just to recognize that the current economic environment won't last forever. And you want to position yourself today to take advantage of what's coming next.
Good advice. Well, thanks, Ric Edelman, and that's RicEdelman.com, RiceDelman.com. Thank you for joining us today.
My pleasure, Jason.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.